Welcome to XRP Pro Ledger. Today we need to address something directly before we get into the data. There is a fundamental disconnect between what retail investors are experiencing when they look at XRP's price chart right now and what the institutional infrastructure being built around this asset actually represents. XRP is trading between $1.43 and $1.45, holding the $1.40 support zone with technical stability. RSI and MACD indicators are characterizing this as a springboard effect. This is the specific compressed setup that historically precedes 20 to 30% directional moves. US spot XRP ETFs have crossed $1.10 billion in cumulative assets under management. Exchange outflow data reveals that 94.4% of recent XRP withdrawals from centralized platforms are being executed by whale-tier addresses, entities holding 1 million XRP or more. Meanwhile, retail accounts for only 5.6% of that outflow activity. And on May 1st, 4 days from now, Coinbase will launch traded settlement functionality for XRP futures. This is a structural upgrade that places XRP on the exact same institutional execution playing field as Bitcoin and gold futures for the very first time in this asset's history. Stay with this analysis through to the end. I am going to walk through the historic Ichimoku Cloud weekly breakout that is currently being tested. I will explain precisely why that specific technical formation, combined with today's institutional infrastructure developments, produces a setup that has only appeared twice before in XRP's entire price history. Let us establish the precise technical context before we address the institutional developments. The springboard characterization that RSI and MACD indicators are generating in the current $1.43 to $1.45 consolidation range has specific historical precedent. This provides the quantitative framework for what follows. The springboard effect in technical analysis refers to a specific condition. Price compresses within a narrow range following a directional move, while momentum indicators reset from overbought or oversold extremes back toward neutral. This creates the conditions for a second, often larger directional move when the compression resolves. XRP's RSI has reset to a level that technical analysts associate with fresh buying capacity rather than exhausted momentum. The MACD bullish crossover confirmed on the daily chart earlier this week has not reversed. It has been consolidating in positive territory. This is the post-crossover behavior that historically precedes sustained directional follow-through rather than a false signal reversal. The $1.40 support zone is holding through multiple sessions of geopolitical uncertainty and legislative delay. This is the demand absorption evidence that confirms the structural floor is real and not a temporary technical artifact. The 20 to 30% rally projection that multiple technical frameworks are generating from the current base targets the $1.72 to $1.89 range. This range includes the $1.87 resistance level that weekly chart analysts have been watching as the next significant technical objective for the past several weeks. The Coinbase traded settlement launch for XRP futures on May 1st is the institutional infrastructure development that most retail-focused commentary is treating as a product announcement. In reality, it is a structural market access event. Understanding the distinction requires understanding how institutional capital actually executes large positions in derivative markets. Traded settlement functionality allows institutional participants, specifically large hedge funds, asset managers, and proprietary trading desks operating at the scale of block orders. It allows them to execute trades at the daily settlement price rather than the real-time market price at the moment of execution. The significance of this for XRP specifically is direct and measurable. Currently, when a hedge fund wants to build or reduce a large XRP futures position, the act of executing that order in the real-time market moves the price against the fund during the execution window. This phenomenon is called price slippage. It reduces the effective execution quality and increases the cost of institutional scale position building. TE's functionality eliminates that slippage risk by guaranteeing execution at the daily settlement price, regardless of position size. Bitcoin has had this functionality. Gold futures have had this functionality. The institutional hedge funds that use TAS for their Bitcoin and gold positions have been unable to apply the same execution quality to XRP futures. May 1st changes that. The capital that has been waiting for institutional-grade execution infrastructure before scaling XRP exposure now has that infrastructure available. I want to isolate the 94.4% whale dominance in exchange outflows for precise analysis. This specific ratio tells you something about the current market structure that the flat price chart obscures entirely. When 94.4% of XRP withdrawals from centralized exchanges are being executed by whale-tier addresses and only 5.6% by retail participants, the market is in a specific structural phase. Institutional analysts call this smart money accumulation. This is a phase characterized by large, sophisticated entities systematically removing supply from the liquid market, while retail participants either hold passively or contribute marginal selling activity. The reason this ratio matters for price analysis is specific. When smart money dominates outflows at a 94.4 to 5.6 ratio, the supply being removed from the exchange order books is being moved by entities whose positions are measured in time horizons of months to years rather than days to weeks. That supply does not return to the market when the price moves up slightly or when a negative headline creates short-term sentiment pressure. It stays in cold storage or long-term custody structures until the entities holding it make a deliberate strategic decision to liquidate, a decision that, at the current accumulation pace, is not imminent. The practical consequence is that the order book depth available for future buyers to execute against is being systematically reduced, while the price is still at $1.43 to $1.45. The institutional buyers entering after May 1st with TAS functionality available will be competing for progressively thinner order book depth in a market where 94.4% of outflows have been well-driven for an extended period. The Russian framework approval for digital currencies and international trade payments is the geopolitical development that most Western-focused analysts are underweighting. Its interaction with XRP's specific technical capabilities creates a cross-border liquidity use case that the institutional community has been modeling for years. Russian authorities officially approving a framework for digital currency use in international trade payments is a sovereign-level policy shift driven by a specific operational necessity. The restriction of traditional SWIFT access has created a settlement infrastructure gap for Russian trade that cannot be filled through conventional correspondent banking channels. The gap requires a neutral, fast, low-cost settlement mechanism that is not subject to the sanctions infrastructure governing SWIFT transactions. The XRP ledger's 3-second settlement finality and transaction costs measured in fractions of a cent are the specific technical capabilities that make it a viable candidate for exactly this use case. And the fact that XRPL operates without a central point of control that can be subjected to sanctions pressure is the specific institutional characteristic that makes it structurally different from any centralized settlement alternative. Analysts tracking this development are noting that Russia's framework approval does not by itself create XRP demand, but it creates the regulatory permission structure within which Russian entities can legally deploy XRP-based settlement infrastructure for international trade. The demand follows the permission structure, and the permission structure was established overnight. The Ichimoku Cloud weekly breakout is the technical signal that I want to address with the precision it deserves. The retail crypto commentary around Ichimoku tends toward either dismissal or enthusiasm without the analytical specificity that makes the signal actionable for institutional-minded investors. The Ichimoku Cloud system generates its most significant directional signal when price breaks above the cloud formation on higher timeframe charts, specifically the weekly chart. The cloud on the weekly represents the aggregation of multiple overlapping time period analyses into a single visual representation of trend, momentum, and support resistance simultaneously. XRP is currently testing a breakout of exactly this formation on the weekly chart. The historical significance of this specific setup is documented. The two previous confirmed weekly Ichimoku Cloud breakouts on XRP's chart coincided with the initiation of the directional moves that ultimately produced XRP's largest historical price appreciation cycles, including the run that reached the $3.40 all-time high. The current test of that formation is happening at a moment when the underlying supply compression is massive. The 94.4% whale outflow dominance, the $1.10 billion ETF AUM structural demand floor, the May 1st TAS institutional execution infrastructure upgrade, and the Russian trade payment framework approval. These are all providing fundamental support for the technical signal to resolve to the upside rather than fail and reverse. Technical signals and fundamental developments confirming the same directional thesis simultaneously are the highest confidence configurations available in market analysis. The $1.10 billion in cumulative ETF assets under management is the institutional demand infrastructure figure that provides the structural context for everything else we are covering today. Understanding what $1.10 billion in ETF AUM actually represents in supply-demand terms requires separating the investment demand dimension from the supply compression dimension. The investment demand dimension is the more widely understood one. $1.10 billion in AUM reflects institutional capital that has made a deliberate, compliance-approved, long-duration allocation to XRP exposure through regulated financial products. That capital did not enter the market because XRP's daily chart looked attractive. It entered because institutional investment committees made fundamental assessments about XRP's regulatory clarity, operational utility, and long-term institutional adoption trajectory. They concluded that the asset belongs in their portfolios at allocation sizes that are reflected in the AUM figure. The supply compression dimension is the less widely discussed but equally important one. Every dollar of ETF AUM requires the ETF manager to hold physical XRP in custody that is not available for secondary market trading. At an average acquisition price somewhere in the $1.40 to $2 range since launch, $1.10 billion in AUM represents hundreds of millions of XRP permanently removed from liquid circulation for the duration of those institutional positions. Combined with the 94.4% whale outflow dominance reducing exchange-accessible supply, the effective liquid supply available for future buyers to execute against is substantially smaller than the total circulating supply figure would suggest. The macro setup that the convergence of these developments creates heading into May deserves to be stated in precise analytical terms rather than in the directional enthusiasm that retail crypto commentary typically applies to setups of this kind. May 1st brings task functionality for XRP futures. This is institutional execution infrastructure that reduces the cost and slippage risk of large-scale position building for hedge funds and asset managers. The weekly Ichimoku Cloud breakout is being tested with fundamental supply-demand data that supports rather than contradicts the technical signal. Russian trade payment framework approval creates a sovereign-level regulatory permission structure for a major new use case, ETF AUM at $1.10 billion with 94.4% whale outflow dominance indicates that the structural demand floor is institutional rather than retail in character. This means it does not erode when retail sentiment turns negative and does not require positive price momentum to sustain. The RSI and MACD Springboard setup on the daily chart is pointing toward a 20 to 30% directional move. Every one of these inputs is independent. They come from different data sources, different analytical frameworks, and different market participants. Their simultaneous convergence in the same direction heading into May is the specific condition that institutional analysts characterize as a high-conviction macro setup. The retail experience of the current market environment is worth addressing directly. The gap between what retail investors are feeling and what the data is showing is the source of the behavioral error that tends to be most costly in markets like this one. Retail investors looking at a $1.43 to $1.45 daily chart with no meaningful candle movement in a news environment characterized by legislative delays and geopolitical uncertainty tend to misinterpret the situation. They interpret the combination of flat price and negative headlines as confirmation that the thesis is not playing out. That interpretation generates selling behavior that contributes additional supply to the institutional accumulation queue at exactly the wrong time. The data does not support that interpretation. The $1.10 billion ETF AUM is not a sign that the thesis is stalling. The 94.4% whale outflow dominance is not a sign that sophisticated participants are losing conviction. The Springboard technical setup is not a sign that the price is preparing to break lower. Each of these data points is a signal that is consistent with a single analytical conclusion. The institutional accumulation phase is in its advanced stages. The supply compression is approaching the threshold at which it creates structural scarcity in the exchange order books. And the catalysts required to trigger the demand acceleration task functionality and Ichimoku confirmation are measured in days and weeks rather than months and quarters. The retail investors experiencing the flat chart as frustration are providing the supply that the institutional buyers at the 94.4% outflow dominance level are absorbing. The complete structural picture that April 27's data assembles is one that deserves a precise final summary. The convergence of signals across technical, institutional, regulatory, and geopolitical dimensions is unusually complete by the standards of any asset class analysis. XRP holds $1.43 to $1.45 with a Springboard technical setup pointing toward 20 to 30% upside. A weekly Ichimoku Cloud breakout is being tested that has only appeared twice before in XRP's history, each time preceding its largest directional moves. ETF AUM at $1.10 billion with 94.4% whale outflow dominance creates a structural demand floor that is institutional in character. It is therefore durable through sentiment cycles that would erode retail-based support levels. May 1st Coinbase task launch places XRP on the same institutional execution playing field as Bitcoin and gold for the first time. Russian trade payment framework approval creates sovereign-level regulatory permission for a major new cross-border liquidity use case. And the RSI and MACD indicators confirm that the technical energy required to drive a meaningful directional move is stored and ready for release. Every one of these signals is independently verifiable from primary sources. Their convergence at this specific moment in the market cycle is the analytical basis on which the institutional participants executing 94.4% of exchange outflows are making their current decisions. The retail investors experiencing the flat chart as a reason for caution are operating on a different and less complete information set. If this analysis changed how you're thinking about XRP, hit like and subscribe. I drop deep dive breakdowns like this twice a day to keep you ahead of the market.